Most people think they understand silver just by checking a green or red price on screens. In my opinion, that habit explains why so many investors get blindsided repeatedly. What looks like a simple price is often the least important part of reality. Right now, silver in New York trades near $74.59 per ounce. A $3 daily move looks exciting, but it hides deeper structural issues. The screen price shows only a partial and often misleading picture. The New York silver price is mostly a paper-based futures price. It relies on contracts, promises, and assumptions of endless metal availability. That system works until physical demand challenges those assumptions. That challenge is happening now, but not where Western investors look. To see real stress, attention must shift toward Asia. In China, the physical silver market tells a completely different story. Buyers there are paying prices near $100 per ounce for real silver. That creates roughly a $25 a gap versus New York paper prices. Such a gap is not normal inefficiency, it signals structural strain. In healthy markets, arbitrage quickly closes small regional price differences. A gap this large suggests the system is under pressure. When regions pay more, physical metal flows toward higher bids. Silver does not care about narratives, charts, or analyst opinions. It moves toward whoever is willing to pay the highest price. Right now, those higher bids are coming from Asia. Asian demand is driven by real industrial needs, not speculation. In China, silver is a critical industrial input. Solar manufacturers rely on silver for panel production. Electric vehicle producers require silver for electrical systems. Electronics companies depend on silver for conductivity. Without silver, production lines slow or shut down. A factory outage can cost millions per day. Paying higher silver prices is cheaper than stopping production. Industrial buyers do not debate valuation when supply is threatened. Alongside industry, wealth preservation demand is also rising in China. Property markets struggle and equities feel unstable. Savers increasingly turn toward hard assets like gold and silver. This adds retail demand on top of industrial consumption. Multiple demand sources compete for limited physical supply. That competition creates shortages and rising stress. Western paper markets are heavily short silver near $74. Those short positions assumed physical supply would always appear. When metal flows east, those assumptions break down quickly. Short positions become dangerous when supply leaves local vaults. From an arbitrage view, the math is obvious. Selling silver at $74 versus $100 is an easy decision. Even after shipping and insurance, profits remain large. This incentive drains silver from Western inventories. As inventories drop, paper prices lose their anchor. Disconnections between paper and physical prices cannot persist forever. Markets force prices higher when local supply disappears. Western prices must rise to close the global gap. Logistics, not hype, eventually drive this adjustment. Recent silver rebounds hint this process has started. A $3 daily jump reflected urgency, not random excitement. Prices in the low 70s were unsustainably cheap globally. That realization can spread very quickly among traders. US physical markets confirm the same message. Coins and bars sell far above official spot prices. Premiums push real purchase prices toward $90 or higher. Dealers even pay above spot to restock inventory. Physical silver is already repricing ahead of paper markets. Either physical demand collapses or paper prices rise. Given industrial realities, demand collapse appears unlikely. Solar expansion and electrification continue regardless of futures markets. Inelastic demand establishes a rising price floor. Year-end timing also plays an important role. Funds care deeply about strong December performance. Tax-driven selling pressure fades as the year ends. January brings new capital allocations into markets. Fresh money often chases recent strong performers like silver. This creates additional upward pressure on prices. The real story is shifting global price discovery. New York no longer exclusively dictates silver pricing. Consumption ultimately drives price, not paper contracts. When major consumers pay triple digits, benchmarks adjust. Watching only one market creates false confidence. A 25-hour regional gap signals major change underway. Structural shifts rarely happen smoothly or quietly. Volatility often accompanies realignment with physical reality. Investors must understand whether they own paper or physical exposure. Paper carries different risks than holding real metal. Volatility does not equal failure in stressed markets. Sharp moves often reflect markets correcting mispricing. Prices never move in straight lines. Direction matters more than perfect timing. When buyers pay $100 and papers print $74, direction is clear. Patience and perspective matter most in such environments. Silver is becoming a strategic asset, not just a trade. Industry requires it, and savers increasingly want it. Supply growth cannot meet both demands easily. History shows this combination rarely resolves quietly. Structural pressure tends to end with higher prices. Subscribe for deeper breakdowns explaining what markets hide beneath prices.